Hello, Empower Nation. Welcome to Empower Her Money podcast. I'm your host, Angela Duncan, and we talk all things money and business. Today's episode is sponsored by morewithangela.com, where I am helping to bring passive income opportunities from the wealthy to you. Keep more, make more, live more. Visit morewithangela.com today. I wanted to do a recap episode. So that's what we're going to focus on today. I was recently at the Grant Cardone Real Estate Summit this weekend. He is my mentor. I have been invested with him for a couple years now, and I love hearing the real estate updates. And I want to provide that information to you because obviously he's very much involved in real estate, and with over $4 billion in assets under management, I think he knows a little bit more than I do. So I go to a mentor and I teach this to a lot of people that if you want to learn more about a specific topic, you want to figure out who are the top players in that world and listen to what they have to say. So I wanted to share some of the information that I learned from him this weekend, and just, the more that I can teach you about real estate investing, the more that I can help you on your financial journey. That is my mission. That is my passion. So let's get right into the notes that I have taken. A couple of updates that he talked about on the real estate market and why we should be looking at commercial real estate as an investment right now. So he still believes that there is a major correction coming in the next 12 to 18 months. We've kind of already seen some of that. The interest rates are high, and it unfortunately has had some adverse effect on some investments where, there are people that were invested in apartment complexes and they've had to unfortunately give those apartment complexes back to the bank because the interest rates have gone up and they were no longer able to cash flow or manage the cash flow on those properties because the cost of that debt or that loan with a higher interest rate exceeded the income that they were able to get. And obviously in some areas, like parts of Texas, the rents just were not going up enough to cover that increase in debt. So we have seen some foreclosures, and you'll probably continue to see that in the news. But that's part of the correction that we are seeing. And Grant went over that there is almost $3 trillion in debt, meaning $3 trillion of debt coming due for apartment complexes in the multifamily space that people are going to have to figure out what to do. And so if the interest rates don't start to trickle down, or if we stay at where we're at, then we may continue to see those foreclosures or some of those bigger apartment complex owners in trouble where they're going to have to hand those assets back to the bank. Now, keep in mind, banks are not in the business of managing apartment complexes. So what happens is when they give those assets back to the bank, they're going to turn around and sell them as quickly and for as much money as possible, which is typically a lot lower than when you can go purchase them on the open market. We've talked before about the Fannie Mae product on the 5% down on 4 units. So I don't want to go over too much of that. That's not something that we normally talk about, but it is an option out there. If you do want to get started in real estate, they do have a program where you can put 5% down. There is a limit on and a cap on the purchase price of that. You must live in that property or intend to live in one of those units for the first year. That's part of the requirement. But it is something that if you want to get into real estate investing, it is an opportunity and still available for you. And then we also talked about the construction, right? Construction has kind of stalled in some areas, not here in Miami. If you look around, there are apartment complexes going up all over the place. We are starting to see a lot more supply in Miami, which will hopefully help out with a lot of people that are still moving to the Florida region. Miami specifically, we get South America, we get Europeans, we still get Canadians. We get a lot of Asians still coming into the market and purchasing some of these assets. So the supply here will hopefully catch up to the demand. But that also could be in the next few years too much supply for us. So we'll continue to watch that and pay attention to the market in Miami. Some of the institutions, they're sitting on the sidelines. They're sitting on a lot of cash kind of to see where this market is going. We are in an election year, which is also very important for us because no matter what side that you are on, either side has different opinions on how to run the economy of the US. And that's important for us as investors because we want to, continue to watch what their plan is, who may be in place, Republican, Democrat. It really doesn't matter because we're going to pay attention to the actual information that they are telling us that they want to do with the economy going forward. So, just paying attention to that and the interest rates, I think, is going to be a big thing for us as we continue to watch the commercial real estate market. Some of the other things, and I need to stop saying, I apologize for those that are listening, but we were checking out some actual deals, right? So there's a product that Grant Cardone offers and it's offered to everybody, but they call it a deal finder. And it's kind of interesting to jump on the deal finder because we're looking at properties that are not on the market for sale, right? And so some of the criteria that we're looking for when we're looking at investing in the multifamily apartment complexes are loans that were given between the 2019 and 2020. Why? Well, when they're going into these loans, a lot of those companies were using short-term debt. So that means that their interest rate adjusts. So say, for example, you had a company or a syndication that came in and bought an apartment complex in 2019. And they acquired a loan or debt on the property and they locked that rate for 5 years. Well, we're in 2024, so that rate is being adjusted. So while they may have enjoyed a 3% interest rate for the past 5 years, it is now going from 3 to 7. So they could potentially be in trouble because their loan is essentially doubling from that 3 to the current 7% market. So when we're looking at people that might be in distress or might be good opportunities for us to come in and purchase apartment complexes much lower than what they purchased, then those are some of the criteria that we're looking at. We're also looking to see if they are, if they maybe bought those apartment complexes via cash, then perhaps they haven't been able to pay their property taxes. So if they're delinquent on property taxes, that could be another indication that that asset group is in trouble and perhaps looking to unload that property at a price that would make sense for us. There's also pre-foreclosure notifications, meaning that perhaps that asset, that apartment complex, is not current on their loan payments. And that is an indication that that property might be distressed as well. And it could be a good buying opportunity for someone who's in the market purchasing apartment complexes. Now, when you're thinking about buying apartment complexes, the first thing that we always look at is the actual deal itself and the numbers. Does it make sense? And then we look at either obtaining debt or raising funds in order to purchase that asset. Some places that you can think about when you are raising funds, and a lot of people think that that is the more difficult part of the deal. Not necessarily, because when you're going into a deal and you know your numbers inside and out, you know the asset, you've done your due diligence, you've looked at debt, you've looked at taxes, you've looked at insurance, which is a huge factor, especially in the Florida and the Texas market. But some ways that you can think about raising funds: your initial friends, your initial family, those are some options. We talked about coworkers. When you are truly in the real estate space, you've done your due diligence, you're educated, you've got great partners around you. You want to tell other people about this investment opportunity because we want to help create wealth for all of those that are around us. So your friends, your family, coworkers. There are local investors, people that perhaps run businesses or have a job, and they're too busy to do the work behind that's needed to get better educated about the real estate space, but they have income set aside that they want to put to work, right? So local investors, local business owners, perhaps people who have equity in their home, as we've seen the increased values of single family homes, especially in the Florida market. Maybe they have equity that they can pull out. Granted, they need to be cautious because they might be pulling it out at 7 and 8%, but if their opportunity will yield them a bigger return, could make sense for them. people with IRAs or 401ks that they can roll over into a multifamily. There are opportunities for us to take those funds and invest it. Hard money lenders, not my favorite avenue. I'm a hard money lender myself, and the rates that we could charge for that are pretty high. So again, the investment needs to make sense for that. And then there's local real estate clubs. For me, Grant Cardone is a real estate club, so that's something that I'm involved in, and it's a great way for us to be able to raise funds for opportunities that we have in front of us. And one of the things I noted on the 10X Deal Finder that Grant Cardone has to offer is that the application itself, when you sign up for it, does give you the ability to skip trace, which means we can potentially grab emails or phone numbers for those asset owners, and we can send out mass emails and mass mailing through that product. So I'm going to check out that product and see if that makes sense for me and my clients and my group. And I talk a lot about real estate investing on this podcast. I do believe that having a mix of real estate and stock market is ideal, at least for myself as an investor. And if you want to have a quiz and see what kind of investor you are, I've actually created a quiz, which is kind of fun for you to do. If you find me on Instagram on EmpowerHERMoney or send me a message with quiz, I'll send you that link, and then you can help figure out what kind of investor you are: conservative, moderate, aggressive. You may have an idea, but it's just a fun quiz that I put out there for my audience to be able to take advantage of. Now, I was talking about real estate and how I do believe that that is one of the best investments opportunities out there. I have a couple of opportunities that I offer my clients, but this purpose of this podcast is really for information purposes. So if you want to know more about that, reach out to me separately. But let's talk about why real estate. Why is real estate a great investment for you? Well, one, it helps protect your capital, right? You're buying an asset. It's a tangible asset. It's a way for you to put money into something that will appreciate over time and help protect your capital. Now, when you buy it correctly, it also can provide you with cash flow, right? Income coming into you monthly, quarterly, depending on the asset. There's not a lot of assets out there that you can purchase that will give you cash flow, right? If you're buying certain assets and they don't give you cash flow, then perhaps appreciation is something that you're looking for. Well, with real estate, you're getting appreciation and the cash flow when you purchase that asset correctly. Long-term appreciation, so your asset, your investment is growing. The overall value of that is now growing with appreciation with real estate. Now, we've had some markets that may go up and down, but for the long term, we typically see appreciation for that asset when you're purchasing it correctly. Those of us that are qualified real estate professionals, meaning we're spending at least 15 hours a week in the real estate space, we also have the ability to have tax write-offs through depreciation, which is a huge offset to someone who might be running a business or have other income. They want to offset that income with the depreciation of real estate to help lower your tax bill. So that's ideal. And we leverage buying real estate, right, with good debt, meaning we're coming into, say, an apartment complex. We're getting a loan, we're getting debt on that property. We're doing it smart. I do have one asset that I do 50%. I'm more conservative, but it's good debt because I'm still cash flowing. I'm still purchasing the property correctly, done my due diligence, and I'm holding on to it for the appreciation long term. It also helps to protect against inflation, right? Because my dollars are appreciating while inflation numbers. And so that kind of offsets that as well. When you're purchasing real estate, we do have access to debt, right? And we talked about good debt, not taking on too much debt for the property, but still making sure that the numbers make sense and looking at potential future, whether or not the interest rate goes up. We want to make sure that we're buying that property and getting correct debt to start with. It's also easier to scale, right? So I raise funds, I purchase apartment complex. I can go do it again and again versus a single family home. It's much harder. I'm not going to go out and raise capital to invest in a single family home to rent it out. I'm going to take that same amount of energy, go out and raise capital for an apartment complex instead. So real estate, while it does have a disruptive potential opportunity, a lot of times the disruption for real estate comes from the debt market. That's what we saw in our housing market crisis in the late 2000s, was really because we had a debt problem. We were giving loans to people who did not truly qualify because we weren't fact checking. We were just doing stated information instead of having them provide documents which showed that they qualified for all of these investment properties, right? So it really was a debt crisis and not a real estate crisis, but the debt crisis led to that real estate crisis. So those are some things that we wrote down for why real estate is a better investment than perhaps the stock market. And some of the things that we want to kind of review and look at when we're investing in real estate: the pricing of apartment complexes, not only today, but in the history. We want to look back to see where that previous owner purchased. And, those are some indicators on where the market could go in the future. We're looking at the cash flow. We're looking at the debt on the property. We're looking at how much equity or how much additional cash do we need to raise in order to make that purchase. When you're working at buying real estate, you definitely want to have a broker involved, meaning a real estate professional who can tell you more about what's the market. Are we expanding in jobs? What is the cap rate or the return in that market? Because it will vary from place to place. What is the increase or the upcoming increase in inventory look like? Because if there's jobs being created, if people are moving there and there's not enough housing being built, then potentially that could be an increase in prices for us. For an owner of the real estate asset, that could be important as well. And then just looking at the overall expenses of that asset and potential increases, such as property management costs or taxes, insurance. And those are very important things when we're looking at real estate. And let's talk now about some of the important factors when underwriting or when looking at a specific real estate investment, like an apartment complex, a storage unit, mobile home parks. Those are some different asset classes within the real estate space that we could be looking at. Location, very important. I want to be in a great neighborhood. I want to be maybe around a Starbucks, a Whole Foods, making sure that they're still building within that area, or it's not something, personally, myself, I don't do opportunity investments such as like lower income Section 8. It's just not an asset class that I'm as familiar with. So I stay in the lane where I'm more familiar with. So location's important. Cash flow, meaning how much cash are we receiving on our investment? That's important. Is this a lender friendly project? If I'm needed to go out and get debt, is the lender going to look at it and say, yes, this is an opportunity that lender is going to lend on? Property manager, also very key. We want to make sure that the property manager is vested, meaning they want to see this asset succeed. We want to make sure that there's not a lot of occupancy, that we have great tenants in place, that we do our due diligence, background checks, making sure that these clients these tenants can pay their rent, and that we're in, a great neighborhood that's growing. So market growth is also very important. And we talked about not having too much debt on the property. So those are some of the key things that we're looking at as well. Looking at worst case scenario, which we kind of are in right now, right? Because interest rates went up so high. But if they continue to go up, or in the future, interest rates are going up, if there's an anchor in that area, meaning if it's a school, then potential future, if that school doesn't continue to grow and we have less population, that could hurt the asset. Or is there a hospital there? Is there a military that's there? What are some things that are helping that market grow? And worst case scenario, if that left, what kind of impact could that have on this asset as well? And we think about future potential of exiting. Are we going to sell the property? What's the future intent for the property as well? Let's go over some mistakes, right? Some things to avoid in real estate investing in general, and not investing, sitting on the sidelines. You're missing out on the opportunities, because in every market, there's always an opportunity for us to invest. Not knowing your market, start where you live, because you likely, if you've lived there long enough, your market, what's going on in that market. But not knowing your market is definitely a mistake before investing. Not knowing how to underwrite a deal, or how to understand how underwriting is done when someone's explaining the asset to you. Not buying in any cycle, right? saying on the sidelines and saying this is not the right market for me is really a mistake, because it's not that it's not the right market, it's that you have lack of education on which market you should be investing in, because every market has great opportunities no matter what cycle we're in. Buying too small, this is definitely something that I've personally done in the past. Single family houses is a lot of work. Fix and flips is a lot of work. So if you're going to take the time to put in the work, why not go into a bigger asset that has bigger appreciation opportunities? Another mistake to avoid is being talked out of deals. If you have people in your sphere that have lost money, or perhaps they just don't know about real estate investing, they're going to talk you out of it because that's just what they do. So getting yourself around the right people so that they can teach you the right way to invest and not avoid doing a deal because someone talked you out of it. Not looking at enough deals. The first deal that you look at may not be the right opportunity for you. So continue to educate yourself and look at lots of different deals to understand different ways of investing, and understanding yourself as an investor is very important. Comparing location or compromising the location because the price is lower. So if a price is lower, there may be a reason behind it. So really truly look at that location and don't compromise on location just because the actual purchase price could be lower and you're thinking, well, I'm going to get into a smaller purchase price to start. Not always the best opportunity for you. Don't want you to make that mistake. Buying a deal that no other offers are. So if you've seen a deal in the market for a little bit, especially on the commercial real estate side, if it's marketed correctly, if the price is done correctly by an experienced broker, if it's on the market for a while, no one's making an offer on it, there's a reason, right? So if you want to look at that deal, then perhaps you're going to look at it at a much different price. But asking the broker, like, why is this sitting? Is this a market seller? Why is the seller selling? Why is the seller selling? Why is the seller selling? Asking that multiple times to go deeper into the answer to find out why the seller is selling. It could be that they just want too much money for it and it's just not the right opportunity in this market. And I've talked about making sure you use a broker in your real estate deal because they can be the buffer between you and the other party. They have a lot of knowledge and experience. When you choose the right broker, they know the market and they will answer your questions and look out for you as an investor. And the last mistake to avoid is don't go at this alone. There are so many of us in the real estate space that would love the opportunity to teach you and help you build generational wealth. Myself is included in that. I teach people about tax liens and about short-term investing and the opportunities that I can provide to my clients. So reach out to me if you have more questions. Hopefully you have enjoyed that recap. If you weren't able to attend a Grant Cardone event, this is my way of giving back. I want to be able to share the information with you. So on this podcast, we teach about money and about investing and about business. And then I help my clients to put that into action and create passive income for themselves and teach you about creating generational wealth for you, your family, and your friends. So thank you so much for joining me again this week on Empower Her Money podcast, where I get to interview incredible women, talk about money, and don't forget to reach out to me. Quiz is my keyword. I will give you that quiz and you can figure out what kind of investor are you. A lot of fun, and thank you so much for tuning in. Thank you so much for tuning into Empower Her Money podcast. Hope you enjoyed this episode. Don't forget to subscribe, share this podcast, and leave a review wherever you are tuning in.